Keep calm and follow the trend. That statement's great until you see somebody's charts that look like this. And here's one way to cut down all the blah, 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 blah. Use something like a standard deviation. I don't use a 1 standard deviation because the odds aren't good enough, only 70%. When you can use the 2 standard deviation, that will give you a 95% chance that price will stay in between those two bands. So if this is the center point of your moving average, price could go down or price could go up, but 95% of the time, it's going to stay inside this channel and return back to this center line. Don't believe me? Let's look at thinkorswim. Standard deviation channel composes of 2 parallel lines, which is the same for a linear regression channel. It gives you an upper and a lower line. Statistical value says that a 1 standard deviation should stay in between those two lines 67% of the time. Not good enough odds. If the number of the standard deviation increases to 2, then 95% of the points are expected to fall inside that channel, likely to move back to the center point unless a major trend reversal takes place. Do you like 95% odds? That means it's going to take your chart from this to this, keeping it nice and clean, showing you the overall trend is up. For this, we're using the LRC and the 2 standard deviation. As you can see, the LRC doesn't really even help, but you can see 95% of the time, which in this case, it's over 100, price always stays in between these two lines. Switch to the next chart with the LRC showing you a signal, but nothing down here where to enter. Next chart, both overlapped here, but again, no lower indication of where to enter into the trade long. Had a couple old signals, but again, sometimes it's just irrelevant where price is. And that's why I like the polynomial way better. It gave you the same signals as the divergence, with 2 other places to take targets. And remember, when these two overlapped, only giving you one indication when to take profits, but never when to enter into the trade to make those profits? The polynomial is on a whole nother level. Where the standard deviation or LRC can't curve, the polynomial will do just that, showing you the exact trend of the bull and the bear at the same time. Are we surprised that price is selling off here? As you can see, the polynomial will show you the support entry area, but the standard deviation and the LRC were too far away. And again, a great place to enter into the trade. And these signals were too far away. Time to take some profits, and these signals were too far away. Standard devi got it right with the polynomial here, but now up against resistance, it's time to take some profits. All 3 got it right at this support level. Only the polynomial showed you where to take some profits, never reaching this outside level. Oh, and because the polynomial curves, great place to re-enter into the trade long, up into this resistance. Because you're able to create 6 different looks with the polynomial, you can make it straight as a board like the others, put a little curve in it, or put a lot of curve in it. The way I like to do it is put 2 polynomial studies on, showing me the outside support levels and resistance, then a quicker one showing me trend continuation resistance. Perfect place to take a trade. Support bounce, consolidation bounce, up into the resistance level, take profits.